Hello, my name is Nelly, and today we are going to be looking at posting to the Ledger account. So before I begin off, make sure you subscribe to the channel, and also I'm going to require you to follow my cursor so that you can be able to get this information quite well since I'm having laid down information. So before I start off with the posting to the Ledger account, I want you to know that when preparing the books of accounts, we go through an accounting cycle, and accounting cycle comprises of the occurrence and documentation of transactions. Then we get to have generalizing, then posting to the ledgers, which we are going to be mainly looking at today, then extraction of a trial balance. Then we are having the end year adjustments, then the preparation of financial statements. So having known the accounting cycle, we now go to our main topic of today, which is posting to the ledger accounts. Now, I want you to understand that posting, this refers to the transfer of information from journals to the ledger accounts, or what you can call the T accounts. Now, this is just a diagram illustrating what I'm talking about by this definition. You can have journals when we are having the general journal, sales journal, and then the process of you transferring or posting to the ledger account is what is called posting. Then I can also still briefly define what a ledger account is, or a T account. So ledger accounts are individual accounts which record a collection of information that relates to a specific type of account. So this can be an asset, liability, equity, revenue, or expense. So having known that, I have a question here for you, which we are going to fill in together so that you'll be able to understand more on how to post to the ledgers. So it's saying MK Limited had the following transactions for the month of January. So they're saying required, prepare a general journal, post the transaction to the respective ledger accounts, then prepare a trial balance. So we're going to be looking at all these three. So with this question, we are going to be preparing general journal, and after preparing a general journal, we're going to post them to the respective ledger account. Then after, we prepare a trial balance. So I want you to pay attention when you're following my cursor so that you'll be able to get all the information that I need you to get. So the question is saying 1st January 2024 started a business with cash 5 million and a bank of 3 million and a motor vehicle of 2 million. So remember, we are dealing with a general journal first. So when we are starting off with our question part A, we are going to give it a good title, MK Limited General Journal for the month of January 2024. So having done that, we get to write the date, description, the folio, the debit side and the credit side. Now, the folio, this is just a point of reference which guides someone where to find the individual account, or it indicates where we find such accounts when we need more information about them. So this is the folio right here. So now our first statement is saying this person started with cash of 5 million, and we know that cash is an asset, so we put it on the debit side. If I told you follow Alice from my previous video, cash is an asset, so you put it on the debit side, and I told you that assets increase by debiting. So since cash is coming in, we debit it by 5 million. Then bank is also coming in and it's an asset, we debit it by 3 million. And motor vehicle is coming in and is also an asset, so we debit it by 2 million. Then capital from Alice, remember I told you that capital is having a normal credit balance, meaning it increases from the credit side and it's coming in. So capital is coming in as a sum of all these three. So when you add 5 plus 3 plus 2, you're going to be getting 10. So this folio number, and then another thing I want you to know, that this folio number will always tell you the number of T accounts or ledger accounts you're going to draw. So if you're saying 4 here, that means you're going to be drawing 4 T accounts. So you're having the first one of cash, the first one of bank, the third one of motor vehicle, and the fourth one of capital. So having known that, we go to the second statement. 2nd Jan 2024, sold goods and received 1 million cash. So what is happening? You can see that when they sell goods, I told you from the previous videos, sales is having a normal credit balance. So it increases from the credit side, and sales also can represent the revenue account, which brings in income to the company. And remember, with income from Alice, incomes increase from the credit side. So this is what is happening. So these are cash sales. So you sold, and in return, you got money, which is cash, and an asset is increasing on the debit side. So you're going to debit cash by 1 million, and then you credit the sales since they increase by crediting. So that is statement number 2. And then we are having another statement, 5th Jan, purchased goods by check of 500,000. So in our journal, we are going to say the date, which is 5th Jan, and then we bring in our purchases. Now, purchases are having a normal debit balance. With these purchases, they can also represent an asset, like an asset can come in, and you know that with assets we get to debit, or they can also represent expenses. If at all you use money to purchase the purchases. So what is happening here is that they are using bank money to buy goods. They purchased goods by this amount, 500. That's why you're seeing that the bank is reducing. So bank has an asset, it reduces on the credit side. So you will debit because purchases are coming in. So you will debit purchases by 500, and also credit bank because bank is reducing by 500,000. So this is it. Then what I want you to notice that purchases and sales are having a normal credit balance, they increase from the credit side. Purchases are having a normal debit balance, they increase from the debit side. Then we go to another statement, which is having 10th Jan 2024, sold goods to Mark on credit worth 200,000. So with this, you're going to come and put your date, 10th Jan, sold goods to Mark. When he sells goods to Mark on credit, that means Mark will come in as a debtor, and you know that debtors are assets to the company. So since it's an asset, this will be increasing. The asset will be increasing of 200,000, and then sales, since they're having a normal credit balance, the increase from the credit side, sales are coming in, and it will be 200,000. Then we go to another statement. We are having bought goods on credit from Rose worth 600,000. So per that statement, Rose is going to be our creditor because we got goods from her on credit. So I told you for the purchases having a normal debit balance, so they increase from the debit side. So you get to show that 600 is coming in. There were purchases of 600, and then you got these, you didn't pay any money, you got them on credit, and then a liability or a creditor is going to come in, and this creditor is having a name, and this person is Rose, which is 600,000. Then we go to another one, which is 15th Jan 2024, paid electricity worth 100,000 cash. So with this, I'm going to give it your date, 15th. Remember, electricity is an expense. So expenses increase by debiting. So you're going to debit 100,000, and then you credit cash, since cash is reducing, and cash is an asset. So an asset reduces from the credit side. So 100 by 100,000 by 100,000. Then we go to another statement that's saying 17th Jan paid wages of 300,000 by check, meaning that bank is going to reduce by 300,000, and wages as an expense they're going to be debited. So the expenses are coming in. So when expenses are coming in, meaning that expenses increase by debiting. So this is what is happening. Wages by 300,000 and bank which is reducing by 300,000. So that is it. Then we go to another statement which is saying 20th Jan 2024 obtained a loan of 3 million through the bank. Then if this person got a loan, meaning that a liability is coming in, he got money, he got bank money, and you can see that bank is increasing. So but when bank is increasing, you you indicate that bank is increasing by 3 million, and then a liability is coming in because this is a loan. A liability is coming in and it is in form of a loan by 3 million. Then we are having 30th Jan 2024, Mark paid half of the amount owing. Remember, Mark had earlier on had gotten goods. He had sold goods to Mark on credit worth 200,000. Now, Mark, remember, is our data and is paying half of the money owing. So half of the 200 is 100,000. So he paid 100,000 and now you will be just demanding him only 100. So when he pays half, meaning that you're going to come and reduce the data. So since data are assets and reduced by crediting, you're going to credit Mark. And then you're going to recognize the cash that is coming from him, which is cash of 100,000, so that the cash is increasing. And I told you that assets, cash is an asset and assets increase by debiting. So this is what is happening here. Then we are having 31st Jan 2024, bought machinery of 1 million cash. So cash is going to reduce by 1 million since you're purchasing it. So this cash, which is an asset, is reducing by 1 million. So you credit, and then an asset which is coming in is going to be debited. This machinery is an asset, so you're going to debit. So assets increase by debiting. So this is what is happening. When you add up the total debits and the total credits, you're going to realize that this is going to give you 16.8 million, and this is also going to give you 16.8 million. Now, when you look at my folio number here, I gave cash, I gave bank 2, I gave motor vehicle 3, capital 4. Now, when you experience cash again, you don't give it 5. You have to go back to 1. You get? That's why I told you you can use this folio number to determine the number of the accounts or ledger accounts you're going to draw. So when you look at this, you're having sales. Sales makes up 5th. Purchases makes up 6th. Bank, we already have it. Mark is coming in for the first time, making number 7. Sales, we already have, so just present 5. Then we are having purchases 6. We already have it. Rose is coming in as a creditor. This is new. So from 7 you go to 8. Then electricity is new. You go to 9. Then cash, we already had it, which is 1 from the start. Then wages is coming in as number 10. Then we have bank. Bank, we already had it. Then we are having also bank. We already had it as number 2. Then loan is coming in as something new, which is number 11. Then cash, we already had it as our number 1. Then the data, we also had it as our number 7. Machinery is new as our number 12, and cash, we already had it as number 1. So with this, you can see that we have ended on number 12. That means we are going to be drawing up 12 T accounts or 12 ledger accounts. I want you to note when you're transferring information from this general journal up here to the ledgers, the transactions that appear in the debit column, these ones here, I've picked out transaction number 2. Transactions that appear in the debit column of the general journal will be posted to the debit side of the respective ledger. This is what I mean. If at all I draw up a T account, and this T account must have a debit side and a credit side, the debit on the left hand side and the credit on the right hand side. So when you're transferring, what is on the debit this side must also must be posted to the debit side of the T account. So this is what I'm trying to mean. The transactions that appear in the debit column of the journal will be posted to the debit side of the respective ledger. This applies to also the entries on the credit column of the general journal. So when you come here on the credit side, what appears on the credit side of the general journal must also appear on the credit side of the T account of that respective ledger, the T account. So I'm going to be using T account. I may not choose ledger because this is in form of a T. It can easily relate to what I'm trying to say. So this is a general journal. It's having a folio, date, description, debit, credit, and after you drawing it up and you're having transaction number which talks about the cash sales, you can see that these ones were debited and this was credited. So when you're posting it to the ledgers, you're just going to come and you be like, this is cash. Now on the debit side, you can post. Now inside the T account, you put the account where the money is coming from. You get? So since we are having cash and under cash the money is coming from the sales, you're going to say sales 1 million. And now you're having sales account, this sales account. So you're going to go on the credit side. Since this is on the credit side of the T account, you put there second Jan cash of 1 million. So this is what is happening here. So, and I already told you that inside that account, you put the account where the money is coming from. So this sales, the money is coming from cash of 1 million. I already talked about the folio as a point of reference, which guides someone to where to find the individual account, this one. And I told you as a shortcut, to know the number of T accounts you're going to draw, you can come on the folio and this will show that you shall have 12 T accounts. So now we are going to question to part B, which was talking about post the transaction to respective ledger accounts. And for the general journal, we know that we are going to be drawing 12 T accounts. So this is when you get to come and you give it a title, cash. This is the title of the T account. Give it a debit side and a credit side. So this is one. We also draft up for bank. Also go in for motor vehicle. Those are 3. Capital. We go in for sales. We go in for purchases. You go in for the data, that is Mark. You go in for the creditor, that is Rose. You go in for the electricity. You go in for wages and also loan. Then finally machinery. Then having drawn them, those are 12 T accounts. Having drawn them, then you start filling in. You just copy and paste from your general journal. So you go to cash, which is your number 1. You go on the debit side and you be like, on the debit side there's 5 million, but this money is from the account of capital. So you go to the debit side of cash. First Jan, you put there 5 million. Then you go to another one. We have also number 1 here. Debit side, the money is coming from sales. So you go to sales. Second, sales 1 million. Then you go to the other one. We have finished sales. We're looking for another one. We are having electricity. Electricity on cash is on the credit side. So we go on the credit side, we put the electricity. So credit side, we put the electricity of 100,000. Then we look for another one from the folio. Find it on electricity. We go look for another one. Another one is here. So we are having data and it's on the debit side. So we go on the debit side, 30th, we put their mark of 100,000. Then we see if we have any other one. Then we have finished electricity, we have finished mark, the data, the debit side. Then we see another one here. So on the credit side of cash account, you're going to put there 1 million, but money is coming from machinery. you go to the credit side, 31st, machinery of 1 million. So having done that, you balance off this account. Since this month of January is ending 31st, so you'll be like 31st, balance carried down of 5 million. How do I get this 5 million? I first add up the 5, the 1 million, and the 100,000, which will amount to 6.1. Then this side, I realize that this side is less. So when I get 6.1 minus 1.1 will give me the balancing figure, which is 5 million. So this will be my closing figure for the cash account. So I'm going to still take you through the steps of how we are going to balance up all those accounts. So balancing off the ledger accounts or the accounts, this is the process of determining the closing balance of an account at the end of a financial period. So the steps are you total both sides. Now if at all I'm having a machinery account here, you total up the debit side and the credit side. So you add up the debit side and the credit side separately. Then the second step, find the difference. So what is the difference between the 1 million and the 0 this side? Because this side will be having a 0. So if one side is smaller, so this side is smaller, it's having a 0. You can first ignore this balance carried down is smaller. Calculate the difference and post it on the side that is smaller, so that both sides be equal. So when I calculate the difference between 100 minus 0, it's going to be 1 million. So this is the difference. The 1 million is the difference. Then step 3, the difference posted is referred to as the closing balance. So this is the closing balance. Name it balance carried down. This is what I have done. So the closing balance is then posted on the opposite side as balance carried down for the next period. So after me naming it, balance carried down. Remember, it close up. Remember, January is having 31 days, so we close up to the end. So 31st, we're having a balance carried down of 1 million. So this will be posted to the opposite side if I told them to have an opening figure in the next period of machinery. So this will cross over. We post it the next period and to act as a balance brought down of machinery. If at all we are opening up period February for machinery, so machinery will begin with an opening figure of 1 million and we post it on the opposite side, meaning that it will have an opening figure on the debit side. So this is what I mean by this step. So having known that, we can go back to balancing off the rest. Before we go to a trial balance, we must first balance off all these. So we are done with cash. So now we're going to go to the second one, which is bank account. So with the bank account, we're going to go on the folio, look for 2. So we're having bank account and 2, we are having 3 million. So this 3 million is going to be capital on the debit side. So we come and put bank first Jan capital of 3 million. Then we look for another one, which is this. You have a second, this is second, another second is appearing on 5th. So we're having bank, but we are going to go on the credit side. We call it purchases. Money is coming from purchases account. So we are going to put purchases on the credit side of 500,000. So we're going to go on the credit side 5th, purchases of 500,000. The next one was happening on 17th here. So we're going to go on the credit side of the bank account and you put there 300, but money is coming from the wages. So we're going to go 17th, put the wages of 300. Then we go to another one. We need on wages here. So we look for another 2, which is this. This is a loan. The loan, we're going to go on the bank side on date number 20th. we put that 3 million on the debit side. So we go the debit side, 20th loan of 3 million. So then from our steps, I told you, you calculate you calculate to know which side is lesser. So this side is 6 million and this side it's lesser. So when you get the difference between 6 million minus this, you're going to get 5.2. So this 5.2, the difference is called the balance carried down. Now when you add up this and this, you're going to get 6 million. So this ending figure, the closing balance, worked as our opening balance in the period of February when we are handling bank. So we have balanced off this T account. So we go to the next one. The next one, which is motor vehicle. So when we look at motor vehicle, we are having 2 million, and this 2 million, you're going to go on the debit side. We put that 2 million, you're going to money is coming from capital. So we go to the T account of motor vehicle, and you can see motor vehicle on the debit side of the T account. We are having first capital of 2 million. Then this, you're going to see that we're not having any other. So we only had motor vehicle once. We only have 1-3. When you look through, so we only have motor vehicle once. When you look through, we don't have any other 3. So meaning we are going to also balance off this T account. So the balance, since this side it's a 0, this side is more. We put here 2 million, and the difference we call it a balance carried down of 2 million. Since 0 minus 2 million, you get 2 million. So this side will balance 2 million, this side will balance as 2 million. Then we go to our fourth T account, which is going to be capital. So we are seeing that capital on the credit side, it's having 10 million, but this 10 million is having figures of cash, bank, and motor vehicle. So we are going to go on the credit side. We're going to go on the credit side of capital, and we put the first cash of 5 million, first bank 3 million, first motor vehicle of 2 million, which add up to 10 million. So this is the lesser side. So 0 minus the 10 million, you can realize that the difference is 10 million. So the balancing figure, we call it a balance carried down, and it will be at the end of the month, which is 31st December. So this will be 10 million, this side will be 10 million. So we have closed off this T account also. So since the capital is only having those accounts, those 3 accounts affecting it, we shall only end with that. So we are going to go to our fifth, which is the sales account. And on the sales account, we're going to go on the credit side, and we put that 1 million, but the money is coming from cash account. So on the credit side of the sales account, so we're going to put that the date second cash of 1 million. So that is it. Then we look for another one. The folio, it is 5. So we look for another 5, which is this, the data. So we're going to go on the credit side, and we put there 200,000, but money is coming from the data called mark. So we're going to go on the credit side of the sales account, put the 10th mark 200,000. Then we get to check if we're having any other 5. So this we look through from here, we do not have any other 5. So meaning that we can balance off also this T account. So balancing off, you add up this and this is going to give you 1.2, and this is going to give you 0. So the difference is going to be 1.2. So you drop it on the debit side, so that this side balances off with the debit side. The credit side balances off with the debit side. So 1.2, 1.2, we call the difference balance carried down. And then we have also balanced off the sales. Then we go to the next one. That was 5. Then we go to 6, which is purchases. So purchases is having 500,000 on the debit side, and money is coming from the bank account. So we are going to go on the debit side. We are going to go on the debit side. We are going to go on the debit side of the purchases. So this is our purchases account. It happened 5th. We're going to call it bank of 500,000. Then we have done that. Then we look for another 6. 6 is here. Another 6 is here. So this 6 is relating with Rose as our creditor. So we're going to go on the debit side of purchases. We put there Rose, who's our creditor. So on the debit side, of purchases, we put there 12 Rose 600,000. So this side is bigger and this side will be less, because from that we won't have any other 6. When you look through from Rose, we do not have any other 6. So meaning we can also balance off that T account. Then this side is more, it is having 1.1 and this side is having 0. So the difference is 1.1, which I'll call it balance carried down. So this side balances off with this one. Then we go to the next one. From 6 we go to the next one. We ended on 6. Then we look for a 7. 7, it is Mark, and Mark is our data. So Mark's account on the debit side, we are going to say that this money is coming from sales account and it's going to be 200,000. So we go to Mark as our data. So this is Mark as our data. On the debit side, then it's going to have sales. And we're going to name it sales of 200,000. This is it. Then we go back. We see if anything happened in his account. So we're having 17 here. We look for to see if there's any other 7. No, we are having 17 here. It was on 10th. So we get to see if there's any other 7 which happened. So we are having another 7 on 30th. So this 7, this Mark account is having 100,000, but on the what? On the credit side. So you're going to come and you call it cash, because money is coming from the cash account. So you're going to go on the credit side of Mark account. You put there 100,000. So this is the credit side of Mark account. You put there 30th cash 100,000. So you get to know which side is bigger and which side is lesser. So this side is bigger. So you first confirm whether there is no any other transaction that took place. So this was 30th. We don't have any other transaction, meaning you can also balance off that account. So you balance off. This is 200. This is 100. So the difference is 100. So you call it balance carried down. So that this balances off with the debit 200k, and also this side 200,000. So that account is also balanced. Then you go to Rose account. Since you have already drawn the T account, so Rose was number 8. Rose was number 8. So you're going to go on the credit side of Rose account. You indicate that you're getting money from purchases. So on the credit side of Rose account, so credit side of Rose account, 12 purchases of 600,000. So you're getting money from the purchases account of 600,000, the credit side. So this side will be bigger, this side will be less, because you only had one transaction with the Rose account, which is number 8. We didn't have any other after that. You look through. So meaning you can also balance off that T account. So 600 and also this side 600. Balance carried down is the difference. Then that T account is also closed. Then you go to the next So after your 8, you look for 9. So this is your 9. Your 9 is electricity. And electricity on the debit side, you're going to have 100,000. So this 100,000, since money is coming from the cash account, you're going to call it 15th Jan cash of 100,000 on the debit side. So you go on the debit side of the electricity account. So 15th cash account 100,000. So this is what I have done. Then since we didn't have any other transaction, didn't have any other 9, when you look through, this is the only 9 we had after 15th. So meaning we can also balance off that account. So 100,000, this is a 0, the difference is 100,000. So we call it balance carried down. 100,000, 100,000, meaning this side has also balanced. Then you go to the next account. Go to draw up another ledger account or T account. So we ended with 9. We look for a 10. This is a 10. So it's relating to wages. So wages, you go on the debit side, money is coming from bank, you drop that 300,000 on the debit side. So you go to the T account, which is having wages. Then on the debit side, put the 17th bank. This money is coming from bank account of 300,000, and you go see if there isn't any other transaction relating to 10. So we do not have any other. So meaning you balance off that account. So to balance off that account, sum up the total. And this is 300 and this is a 0. So the difference is 300, which you're going to call balance carried down of 300. So this side balance is 300 and this side balance is 300. So you have also balanced off the wages account. So you go to the next one, which is going to be from 10 you go to 11. So this is a loan. So the loan account, on the credit side of the loan account, you're going to call money is coming from bank. You're going to put the 20th Jan bank, and then you put 3 million on the credit side. So you go to loan account. So the loan account is having 20th bank 3 million. So you're going to check if there isn't any other transaction that happened after 20th. So you have 11, that's the only 11 you're having. So you also balance up that account. You add up, this is 3 million, this is a 0 this side. So the difference is a 3 million, which you're going to call a balance carried down of 3 million. So 3 million balances with the 3 million on the debit side. So this account I have also balanced it off. So you go to the next one. So from 11, you look for a 12, which is machinery. So machinery is having 1 million on the debit side, which you're going to where money is coming from the cash account. So you're going to go to the debit side of the machinery account. You call it cash. Debit side of machinery, call it 31st cash 1 million, and then the difference is the balancing figure, which is 1 million, which you're going to call balance carried down. Balance is off with 1 million, 1 million. So I've also balanced off that account. So meaning you have also completed question B, posting the transaction to the respective ledger. So you have balanced off all those ledger accounts. So you're going to prepare a trial balance as your last, and with the trial balance, you just use end of year figures from the T accounts. So this cash is having an end of year figure 5 million, bank is having 5.2, motor vehicle is having 2 million, capital is having 10 million, and then sales is having 1.2, then purchases is having 1.1, mark account is having 100,000, then Rose is having 600,000, then electricity is having 100,000, then wages is having 300,000, loan is having 3 million, machinery is having 1 million. So for machinery, since it's an asset, it will have a normal debit balance. So this is transferred on the opposite side so that it gets to have a normal debit balance. Loan is going to have a normal credit balance. So this figure of 3 million is what is going to be posted on the trial balance but on the credit side, and for machinery it's going to be the 1 million that's going to be posted on the debit side of the trial balance. Then wages, it's having a normal debit balance, so it's what is going to be posted on the debit side of the trial balance. So electricity is having a normal debit balance, so this is going to be posted on the debit side. Where you see this arrow, where you see it going, it's where the side, it's the side which is going to receive the money with the T account. So 600 is going to be on the debit side, since a creditor is having a normal credit balance. Then a debtor is having a normal debit balance, but of 100,000. So this purchases is going to have a normal debit balance. Capital, normal credit balance of 10 million. Motor vehicle, normal debit balance of 2 million. Then bank, normal debit balance of 5.2 million. Then cash is going to have a normal debit balance of 5 million. So it's what you come and post on the trial balance. So you can see your trial balance. You can give it a title trial balance as at 31st Jan 2024. So we're having the details of the details, debit side and the credit side. You can decide to put your shillings, US dollars, depending on whatever currency they have given you, in which these amounts were. So you have in cash, I told you cash is an asset, and assets have a normal debit balance. So you're going to go to cash, and you have in cash of 5 million. So this 5 million is going to be on the debit side. It's having a normal debit balance of 5 million. So you go post this 5 million on the debit side. Then bank has an asset, it's also having a normal debit balance. But bank, if it's not an overdraft, if it's an overdraft, that's when it will have a normal credit balance, like a balance opening up from the credit side. But um, this is not a bank overdraft. This is a normal bank transaction. They did not have any bank overdrafts. So you're going to have this figure of 5.2 on the debit side. You have this amount of 2 million on the debit side, as you see this arrow. Capital on the credit side, sales on the credit side, purchases on the debit side with this figure, and then mark on the debit side with 100, rose with 600 on the credit side, electricity 100,000 on the debit side, then wages 300,000 on the debit side, then loan 3 million on the credit side, then finally machinery on the debit side with 1 million. So it's what you come and post to your T account. 5 million, 5.2 debit side, motor vehicle 2 million, capital is having a normal credit balance, sales is having a normal credit balance of 1.2, purchase is having a normal debit balance of 1.1, the data whose mark is having a normal debit balance of 100,000, creditor Rose is having a normal credit balance of 600,000, then electricity is having a normal debit balance, wages is having a normal debit balance of 300, loan is having a normal credit balance of 3 million, and machinery is having a normal debit balance of 1 million. So when you add up the debits and the credits, you're going to get 4.8. So debits are 4.8 and the credits are also 4.8. So meaning your trial balance has balanced. Thank you so much for watching. Make sure you subscribe to the channel.